Hello, I'm Brent Joyce, Chief Investment Strategist for BMO Private Wealth. It's Tuesday, November the 25th, and it's forecast time. As is traditional this time of year, we outline our 2026 capital markets forecasts. We remain constructive on the global economy looking out to next year, and our base case calls for cash, bonds, stocks, and alternatives to deliver results commensurate with their long-run averages and consistent with the solid underlying fundamentals currently in place. Our outlook is optimistic, yet realistic, given solid equity market gains over the past 3 years. It's worth remembering that the current bull market advance began in late 2022, with calendar year returns for bonds and stocks significantly negative that year. We say solid equity market gains and not exuberant, a word many are using, because the so-called rally in everything needs context. First, it is a recent story. Second, it hasn't been a rally beyond expectations across the board, nor has absolutely everything rallied. The areas of outperformance within equity markets stem from a combination of 3 factors: the starting point, genuinely justified by fundamentals, and potential overexuberance. First, the starting point matters. Advances in Canadian, European, and emerging markets in 2025 have an element of what were once undervalued are no longer. Pockets of value remain, and investing in good companies at reasonable prices versus getting a bargain is still a prudent strategy. There remain enough opportunities where prices are not unpalatably expensive. This is also true for a broad swath of U.S. equities outside of the largest companies that have dominated headlines and index performance. Next, earnings growth matters. Some of the equity market gains are justified upward share price movements based on earnings growth, the only fundamental that matters in the long run. These fundamental advances are not limited to companies in the AI space. We have seen earnings growth broaden across more geographic regions, sectors, and companies. Our base case forecast calls for a continuation of this broadening out of participation, but a moderating trajectory for the equity market rally. And lastly, yes, we do believe there are some pockets of overexuberance within equity markets. Investors who remain disciplined and diversified both participate in these areas and mitigate the risks that may be brewing there. We should not paint the entire equity market universe with a broad brush of, oh my, everything's overpriced, priced for perfection. We should not fear what equity markets are supposed to do. Nor should we shy away from investing in stocks because the outcomes have delivered on the long-term promise of why we invest in stocks in the first place: the demonstrated ability to grow wealth over time and protect our wealth from inflation. Our outlooks for economic growth, inflation, central bank policy, and bond yields are supportive of further gains from the capital markets: cash, bonds, stocks, and alternatives. Part of our forecasting framework asks, why would an asset deliver returns different from its long-run average? For 2026, we see nothing to suggest a major disconnect between cash and bonds and their fundamental drivers. We expect cash to deliver returns close to the rate of inflation, 2 to 2.5%, a totally normal and healthy situation. Similarly, for the bond market, bonds are priced for the growth and inflation backdrop we anticipate, and expectations are for central banks to do relatively little compared to the last 4 years. Remember, globally, policy rates went way up and have been coming down to where we are likely close to the right spot, the so-called neutral rate in central banker speak. We expect a few more rate cuts from the U.S. Federal Reserve, but most other central banks, including the Bank of Canada, are done or very close to being done with their rate-cutting cycles. This is a recent development, meaning the benefits of those rate cuts will continue to course through the economy. Bond yields, however, have moved in anticipation of this environment. We see U.S. and Canadian 10-year bond yields little changed from today's levels, calling for 3% in Canada and 4% in the U.S., putting the total return for Canadian fixed income aligned with current yields to maturity in the 3 to 3.5% range. Importantly, the bond market and central banks in concert have ample room to deliver safety and stimulus should the backdrop deteriorate enough to require it. For equity markets, looking forward, there are plenty of positives, and many of the negatives have shown that they can be muted or transitory. However, given that parts of the equity market have moved to reflect the positive backdrop, aggregate index level valuations are elevated. So, we do not see a continuation of the heady yearly percentage gains of the past 3 years. We expect investors to be more judicious in rewarding winners versus losers, resulting in a broadening out of participation. There remain reasons for caution. Investors should be mindful of their time horizon and risk tolerance, and also take opportunities to rebalance back to well-diversified portfolios. Overall, our assessment of the backdrop points to continued stock market gains, and we recommend a slight overweight to stocks. With percentage earnings growth in the mid-teens across most global markets and some downward wiggle room on valuations, we see high single to low double-digit gains for most equity markets. Specifically, our base case scenario calls for the S&P TSX to hit 34,000 and the S&P 500 to reach 7,400 by the end of 2026. There is a lot for investors to like about the current environment, one in which the economy is performing reasonably well, with scope for upside surprises. We think the drivers of returns will broaden out. This is good news for well-diversified investors who may feel a bit of FOMO in 2025. We see that discipline being rewarded in 2026. Thank you for watching. Here's to a great 2026.